Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. Kelvin Wong, founder of the Lighthouse Chronicle, is our guest today on the first show of the year. Kelvin, great to have you on the show again.
Hi, good to see you again, Brian, and Happy New Year.
Happy New Year. Now, Kelvin, before we get your insights, let's take a look and see how markets have performed in the first half of the day on the first trading day. Now, we've got Bitcoin, which is at 16,686. It's up 0.31%. Ethereum is at 1,213. It's up 1.02%. Looking across the regional equity markets, we start close to home for you, Kelvin. The SGX is down 0.59%. Bursa Malaysia is down 1.19%. Shanghai is up 0.56%. The ASX All Ordinaries is down 1.33%. The Nikkei is unchanged. The Hang Seng is up 1.36%. And rounding up the numbers, we've got the Kospi, which is down 0.23%. Kelvin, that's pretty mixed market across the region. Tell us why.
Yes, so definitely, if you look at the current performance right now, it's rather mixed. So I would say that do not take so much we call it a view on these numbers that it will dictate the performance for the start of this for the rest of the week. As you all know, that liquidity is still thin at this moment in time, where most of the institutions are still actually off for their Christmas and New Year break. So I do not see any clear directional bias based on this current performance statistics that we see at this moment in time for the Asia major stock indices.
Now, what's interesting, Kelvin, however, is movement in the yen today in Asian sessions.
Yes.
Tell us about that and what are its implications?
Yeah, precisely. So firstly, let's talk about the performance of this dollar yen. So we could see a very significant movement of the yen strength coming across the board. We see yen strengthening against the dollar, yen strengthening against the euro, and yen strengthening against the Aussie and the Kiwi. So particular one of this movement in the short-term perspective is number one, do not forget that Japan market is actually closed for holidays today. That means we talk about the institutional trading desk of Japan banks are actually there's no one manning the desk at this moment in time. So liquidity is indirectly kind of low at this moment in time. And we could actually potentially, what we could see right now, especially in the 3-4 hours of Asia session, is stop loss being triggered around this 131 figure level, which is potentially technically is a key support as well. Psychologically, it's a round figure level where potentially we start to see a lot of short-term option expiry level at this level. So what we could see right now is actually a pierce through this support level where lots of potentially a long bias position that's being closed out for dollar yen. So that's why you see this steep fall of close to more than one big figure level. So in fact, actually dropped close to 1.2 points, which is 0.9%, which is quite significant at the start of today's Asia session. And in fact, it's trading close to a 6-month low right now, which is at 129.60 level. So short-term wise, we start to see a stop loss being triggered, and also fundamentally it's being actually backed by a change of tone of BOJ. So what we could see in the last meeting in December is that they start to actually shift their yield curve control. That means they widen the band to allow the Japanese 10-year yield to actually fluctuate higher to a ceiling of 0.5 basis points. So that could potentially be a prelude to a more tighter monetary policy in 2023 that actually supporting this yen strength here.
And Kelvin, what does that mean for other asset classes?
Yeah, so probably I want to stick to the notion over here is, as you all know, that Japanese yen itself is one of the key, I would say that major trading component in the FX market, and it's the second largest weightage in the dollar index. So traditionally, most of the time we start to see dollar weakness, which is actually primarily driven by the yen strength, as well followed by euro and sterling. It's actually good for this asset. Traditionally, we start to see what we say because very likely there will be a flow of funds back towards the rest of the world, apart from US. Then also we talk about liquidity conditions starts to actually loosen as well, which is something in line with the dollar weakness narrative. But bear in mind, this is a bit significant, different why at this point in time. It's because if you look at the Japanese authorities or the Japanese central bank, after close to more than a decade of ultra loose monetary policy, and the policy is actually definitely much looser compared to the rest of the developed nation like the Fed and even ECB. and they start to what we call deploy exotic form of a creative quantitative easing program, which is come up with the yield curve control is one of them, and buying of ETFs. Yeah. So what we could see is the sudden change of this monetary policy from the Japanese authority that may actually trigger a wider negative feedback loop into the system. Because why? Based on behavioral finance, market participant has been accustomed to this almost decade long of forever BOJ, the ultra easing policy, where now there's a sudden shock to the market, where do not forget they may start to see a reversal of this behavior. Why? Because if you look at the last 5 to 6 years, Japan itself are actually the net exporter of international capital. So what do I mean by this? We're talking about institutions, fund management company from Japan. They actually export their local capital to overseas market. It means, i.e., they invest in FDI in US, in Europe, in Southeast Asia, whatsoever.
Yeah, because they're chasing yields, right? Essentially.
They're chasing yields because, and if you talk about yields start to actually improve significantly in Japan, we start to see this potential repatriation of funds back into Japan from the rest of the world. And do not forget, one of the one of the what I call pool of overseas investment is US Treasury fixed income, which is if you look at based on various statistics, the Japanese is actually one of the key investors, or major we call it top 10 or top 5 investors in US Treasury bonds, big bonds and notes. Okay, so what we see, if there's this potential repatriation of funds, we may start to see this 10-year or longer term treasury yield being pushed up. So in fact, the movement of the treasury yield has started to tick up in the last 2 weeks of December from 3.5%. Now, if you're looking at 3.8%, which is quite significant. So with long-term yields that are being here elevated by this repatriation of Japanese funds, even though we may start to see Fed itself starts to be less hawkish this year, I do not see it, this long-term treasury yield being tempered out to below 3.5%. So in fact, they may still stay elevated at this range of 3.8 to 4.5%. So that being said, over here, we may start to see a bit of downside pressure for long duration assets, risk assets that potentially we're talking about tech stocks, growth stocks, which could still see much, we call it headwinds in 2023, at least for Q1 of this year.
Now, Kelvin, thank you very much for your insights, and thanks for coming on the show.
Sure, my pleasure, Brian. Yeah.
Now, we've been speaking to Kelvin Wong, founder of the Lighthouse Chronicle, on BizStack's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This video and podcast will be on our website, www.bizstack.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.